Welcome to BAM It with John Michael and Mari, covering all things business, accounting, management, marketing, and IT, the place where businesses and entrepreneurs find the forest through the trees.
Hello and welcome to BAM It. This is Mari Peterson with Marketing Outpost, and of course here with me is
John Michael Kledis with Peridot Consulting.
We want to thank you for joining us today. Today's episode is really exciting and interesting, and I'm just going to leave off with that first.
I love how you jump into this with major sarcasm, and anytime we talk about taxes, Mari's like, this is going to be great.
I'm just trying to drum up some motivation and excitement here.
Well, it's very transparent. Your sarcasm is transparent.
I love taxes. Oh, yeah. Anyway, so today we're going to talk about state and local taxes. State meaning not a state, but state as in your state. And our state is North Carolina. So we're going to be talking about that. But before we get started, I thought I'd like to hear John Michael's interesting fact.
It's all interesting facts, Mari, but they started, as in the federal government, obviously America has a huge history with taxation all the way back to the Tea Party, but we started collecting income taxes during the Civil War to start making more money during the Civil War, and it was actually, at the time, considered semi-unconstitutional, and it got challenged a lot until they finally passed the 16th Amendment in 1913, which basically said the Congress has the power to collect income taxes. And soon after that is when, states started collecting income taxes, and then a few years later, sales taxes, and then a few years after that, payroll taxes.
That was the interesting fact.
Well, it's just a history.
Well, I'm going to make an observation. I think that people are very aware of, those three types of taxes, but they may not be so aware of all the other little taxes that hit your life. And so basically, I read somewhere that throughout your 24-hour day, you are basically taxed every minute. So when you go to sleep, of course, you're paying your heating and air. You're being taxed on that. You're paying for your home that you're in, the property tax. You're paying when you wake up and you go to the bathroom, take a shower. You're paying a tax on your water. You get dressed and you have breakfast. You pay taxes on your food. You go out to your car. You're paying taxes on that. So basically, every minute of every part of your life, there is a tax. So that's just an observation, maybe not so interesting. But then the other thing that I find interesting, I'm reading a lot of articles lately about how people are vacating high tax states and going to the lower tax states. And that is why so many people are going to Florida and South Carolina and North Carolina. What bothers me about that is that once they get here, then they turn around and start wanting to add on more taxes here because they're not happy with our roads and our greenways and all this stuff. That's
not necessarily true. You got to think some of these states, I've got, clients in New York, and if they're high income earners and they're paying the top tax rate of 32%, 4%, and they also have a 15% tax, high tax, that's a high tax state, 10, 15%. They're paying 50% of your net income to taxes. So high tax states, it's an issue. And the new tax law, they you get a deduction for state taxes, you do, but they minimize that by capping it at $10,000. So a lot of people in high tax states are losing out if you're, potentially on a large deduction there.
I know, and I just find it interesting that then they move here and everybody wants to start adding on more taxes to pay for stuff that they had when they were before.
A bitter Southerner.
I am. And I'm just like, okay, you just left a high tax state. Now we want to all of a sudden implement new debt and taxes to ramp it back up. So eventually the entire country will be a high tax country.
Yeah, I mean, I'm not, I see the merit in taxes, and Mari's tongue-tying me here because I just think it's funny that she's the bitter, I'm taxed enough already. Southerner.
I am. But then here's the other thing. Think about it. Taxes is one of the one subjects people have gone to war over and fought, and people have died over it.
Well, that and religion and territory and not
Exactly.
millions of other things. They've won independence over it. We can definitely attest to that. Well, to Mari's point, we are taxed, and anytime you're taxed, it is a lot. It's material, but there's actually 7 types of taxes or 7 ways we're taxed. There's the income tax that we know about. There's sales tax on goods. If you go to the store and buy some milk, you're paying sales tax on that. If you get like you said, your utilities, there's taxes on that. That's sales tax. There's excise taxes. These are similar to sales tax, but they're taxed in some ways the producers. They call these the sin products tax in some cases, like breweries have to pay excise tax, gas companies, cigarettes, liquor, you have to pay excise tax.
How do you feel? What category does the new sugar tax in some of these states fall under?
I don't know if I know what you're talking about. The new sugar tax?
Yeah, like California has implemented these new taxes
It's probably a sales tax.
on, like an additional tax on, let's say, sodas.
Yeah, that's a sales tax. So if you look at any state's sales tax form, it's going to have like 10 categories. So if I get small businesses all the time asking me to help them with their sales tax, and the forms are confusing because there's food gets taxed at one rate and liquor, and every state's different, and in many cases every county is different, and that can get confusing. But we got income tax, sales tax, excise taxes. There's payroll taxes. You guys are familiar with Social Security and Medicare tax. There's property taxes. You own a house, you have to pay property tax. In some states or counties, you own a vehicle, you have to pay vehicle tax, trailer tax. It depends. Every state's different. I think Tennessee might have like a will tax. They don't have property tax. I don't know. Maybe not. But my point is it can vary. There's estate taxes. They refer to that as like the death tax. If your estate's over about 11.4 million, then there could be a tax on that. And there's the gift tax, which if you give somebody more than $15,000 of something or money, you might have to pay tax on that. So those are the 7 types of taxes. So when you kind of think about all those, I'm sure at some point we're being taxed, and 24 hours a day, if you're making passive income, then you can, I guess, say you're being taxed at some point. And then there's 3 primary taxing agencies. Well, there's a ton of taxing agencies, but 3 sources of that. One is the federal taxes. That's your Internal Revenue Service. Federal taxes, the Internal Revenue Service, they do income taxes, they do payroll taxes, they do the excise taxes, they do gift taxes, and they do estate taxes. And then there's state taxes, which are from the state taxing agencies. Generally, it's a something Department of Revenue. So it's North Carolina Department of Revenue, Tennessee Department of Revenue, North Dakota, I don't know, Department of Revenue. And state taxes generally do income taxes, sales taxes, and excise taxes as well. And then you get down to the local taxes, which is local is county and city. So you got in the cities and counties, they do property taxes, and they also do sales taxes. So if you
School taxes.
Yeah, there's school taxes, which are
Then
part
there's
of
the new
property
taxes that they like to add on when they pass bonds. Where does that fall under?
Property taxes. You got to look at their source of revenue. So they may do a property tax increase. They may
I feel like I have entered Dante's Inferno. So instead of like 9 circles of hell, we have 7 circles of taxes.
Yeah, well, definitely circles. That's for sure.
I think that's what I'm going to call this title, John Michael.
7 circles of taxes.
Dante's Tax Inferno.
Well, the point is we're looking at we're talking about all the ways you're getting taxed, and
this
the
just
different
proves my
sources.
point, though. You basically get taxed waking and sleeping 24 hours a day. You are taxed on something.
Yeah, but tax is a percentage. Keep that in mind. It's not over 100%.
So if you added all that up, what would be the total? Like everything really, like you get in your car and you go pump gas That's a gas tax. You're on the road, there's a road tax that gets applied somewhere.
Yeah, it's a lot. It's a lot, but also it's part of being in a society, Maury, that you have to pay tax.
When is enough enough?
You need to take it back a notch on your...
I'm just asking.
So, society needs tax. We know that. And it's not fun. Are
you taking this personally?
No. I'm
not saying that we don't need accountants. I'm just saying, when is enough on the taxes already? Okay, I'll stop. So moving on.
Okay, so most of the taxes that we talked about are self-explanable in how they come or how they get paid. Some of them you're paying, you don't know it, even think about it, like sales tax or fuel tax, things like that. Property taxes, you might be more aware because you might have to cut that check. And income taxes, sometimes even when it's withheld on your W-2, you don't even realize it. I'll have clients on their tax return like, oh, I'm getting a refund. Like, yeah, you're getting a refund, but you still paid in like $15,000 in tax. You're just not filling it because it was taken out of your W-2. It was withheld. But we want to talk about states and specifically because they can be unique in many ways. And one thing to know about states is that every state is very unique in their system. So if you're in a certain state, you got to be kind of aware, and it can be confusing if you're a person of multiple states as to what's taxed and what's not. Every state does have income tax except for about 12 or 13. Those are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. I didn't count. How many was that? About 10 or 11. Well, who cares? So those states matter when it comes to tax planning. Mari's over there daydreaming. I'm looking at her computer right now. She's Googling something.
Yeah, I was going to look at more tax stuff to make
She's
you mad.
Just ranting. She's venting over here. I'm not the tax man. I always have to tell clients, I'm on your side. I'm not on the IRS's side. However,
Is this where we say don't shoot the messenger?
Correct. Don't shoot the messenger. So you got those states that don't have income taxes, but when you're in a state that has income tax, states pretty much, for the most part, just piggyback the IRS or the federal 1040 or the federal taxes. What they do is they take that, that AGI from that 1040, and then they say, okay, we're going to up and down it for certain credits or deductions that are unique to our state, and then we'll apply a tax rate. Some states have a flat tax rate. North Carolina is just under 5%, for example, and some are graduated, like the federal tax thing. The more money you make, it may go up and whatever, and it depends on the state. Some states tax capital gains, some don't. Some tax estates, and some don't. So, the nuances of each, and some have certain credits. Some allow you to deduct certain retirement, and some don't. So there's a lot of potential deductions that could be missed just out of ignorance to those states' tax laws. I know New York has a rental deduction, which is pretty cool. We definitely don't have that here in North Carolina.
That's because the rent's so high.
Well, rent's high anywhere, Maury, if you want to
Rent
go
is
there.
relative.
Rent is relative. Oh, am I going after you now, Maury?
Affordable rent is relative.
It is. It is very relative. You're correct, as are taxes. So what I'm trying to get across is every state's different. One thing that is unique to states is sales tax, and because the federal government doesn't do a sales tax. So the way that works is basically if you're selling something, you're a collection agent for the state. It is on you to collect those taxes, compile them, and send them off to your state Department of Revenue. And if you don't, and you get audited, you're liable for those taxes if you collected them or not. So if you are supposed to collect a 7% sales tax on that $100 sale and you don't do it, the state's going to say that's, I don't care if you didn't do it, you still owe us $7. So the point is research if what you're doing is applicable for a sales tax, then make sure you collect it and pass that on to your customers. And it doesn't affect your net income because you're passing on those that cost to the customer, and they're paying it for you, but you got to collect that money and then turn around and report it to your Department of Revenue and pay that money. And you're liable for it. It's your responsibility. So just being aware of what constitutes that sales tax. Usually if you're exchanging a product, it's a sales taxable event. Sort of a new thing in this realm is internet sales. Internet sales kind of historically have been kind of the Wild West of sales, and you didn't have to do any sales tax on it. So if you sold anything over the internet, you didn't have to do it. But they just passed a Supreme Court case. It was called South Dakota versus Wayfair. Wayfair, the online furniture. Mm-hmm. Wayfair, you just got what I need. They just got a free ad.
That's half of our stuff in our office.
Yeah.
That I had to assemble.
They went to court, and basically they said that individual states can require online sellers to collect state sales tax on their states. And prior to that, it was basically the consumer's responsibility to report a use tax. So North Carolina has that, for example. So it says if you buy anything online, you bought $100 worth of stuff online, you didn't pay sales tax, you should have, you live in North Carolina, you got to give us a use tax, which is kind of like a reverse sales tax, because you got something that you're using that didn't have a sales tax on it. So you now are responsible for that. That's a use tax. Use taxes also come in if you're a retailer. Say you're breweries have this a lot. They give shift beers, for example, to the bands that come play at their brewery, and they're giving these beers for free to play at their brewery. Well, they didn't sell them the beer, so they didn't sell them the beer, and they didn't collect sales tax. But if you give a beer away, that brewery has to pay a use tax on that beer. So they have to report those beers and send in a use tax based off of what they've given away, for example. So if you give something away and you're supposed to be charging sales tax, you have to pay that use tax. If you receive something via internet sales, you have to pay that use tax. So that can be confusing, but now states are going to start trying to collect sales tax if you sell online to that state. And there's right now about 24 states that are doing that. So if you're in North Carolina and you sell to Nevada, something over Etsy, then that transaction, you may have to report Nevada sales tax to Nevada for that transaction. Now, most states understand that's just a major burden, and it's not going to happen. So a lot of them, for example, North Carolina does this. They say you have to do $100,000 minimum of sales in that state or 200 transactions. So at this point, I think most of them are like that. So if you're just doing piecemeal here or there, and you get one person in Nevada, one person in New York, then you could and you're selling it online, you could probably get away from the doing the online sales tax. But it's kind of a new thing, and obviously with the way we're moving in society, it's going to be more and more of a issue, and states don't want to necessarily lose out on that when there's going to be less and less brick and mortar and more online sales.
Who is enforcing that kind of stuff? It's up to the state?
It's the State Department of Revenue. So what they'll do is everybody pays taxes or reports taxes. And say if you sell to a business in Nevada and they get audited and they see that they wrote you a $100 check, then they can say, well, here's the sales tax. No, and they could potentially, if you reach their threshold or whatever, if it's material enough for them to do it, send you a letter saying, according to our records, you owe us, sales tax. But the State Department, this is all State Department of Revenues. This has nothing to do with the IRS that does this. And the basic rules, though, is Nexus. Nexus means physical presence. And if you're in a state, you collect sales tax for that state. So then the online sales basically muddy up that water a little bit. I will say, as this offshoot, when you asked me about who enforces that, the states and even to a certain extent local governments do the heavy lifting when it comes to audits. The IRS doesn't do, they do plenty, but they don't do as many audits as the Department of Revenues do, or even local governments. And what will happen is you'll get audited, and if the State Department of Revenue makes a change or doesn't agree with your deductions, then you have to tell the IRS an amended tax return, and the IRS will get a copy of that. So with the IRS losing a lot of funding, they're relying more and more on these state revenue agencies to do more of the auditing. So a lot of times people will be like, oh, I'm afraid of the IRS.
You should be afraid of your state revenue.
Correct. It's the State Department of Revenue that's going to probably be getting you.
So let me ask you an offside question. I don't know where this falls in, but I have clients that are artists, and they sell their goods through these art craft shows and festivals, and they're often in other states. So they make their product here, and they go sell it in, surrounding states or whatnot. Do they have to charge a tax?
Yeah.
Who collects it and who monitors that?
The Department of Revenues do. What will happen is it may back into it, and a lot of times it's not material enough. But the short answer is, yeah, they should do tax, and depending on the state.
When you say it's not material enough, what do you mean? I mean, if I go to an art show, let's say I go to Spoleto in Charleston, and there's a lot of high-end products being sold there, then that's very material.
I was talking about somebody going down and selling like $20 earrings or something. But
I have clients that are selling $10,000 pieces of jewelry, so that's what I'm saying.
Well, they need to be aware of the state rules. There's two things going on there, and we're going to get into this Nexus argument here in a minute, but we can kind of bleed into it with that question is, if you're physically in a state, it doesn't matter where you're from, because if it mattered where you're from, everybody would be from Florida, or Tennessee. If you're physically in a state earning money in that state, selling a product in that state, then that state, you owe that state income tax and potentially sales tax.
So that's what's interesting to me, because let's say this Charleston is known for all these very nice festivals, and they usually have very high-end items being sold there of some type, art, painting, pottery, whatever it is, glass. So that's a lot of money going through these exhibits and these festivals and shows. So are you saying that the festival show group is responsible for turning around and reporting that? But they probably don't even know.
It's the individuals.
Each individual vendor,
correct,
is supposedly turning around and saying, oh, I made $60,000 in sales here. I sold 5 paintings or whatever. And they're supposed to be turning around and paying South Carolina, even though they may have been a wildlife painter from, Alaska.
Correct. Now, you can deduct the expenses against that if you have any. I mean, don't forget that.
But I'm sure they are deducting the expenses. The question is are they reporting that income through their own state only, and then they're supposed to also report an income to the additional state?
Correct. If you have physical presence, which the term is Nexus, in a state, and you are earning money, earning income in that state, you owe that state that portion of the income tax and potentially sales tax. So it's imagine this scenario. You're a band and you are in a bus.
Yeah, that's a good example.
And you drive across country, and every night you're in a different state doing a different gig.
Yeah.
That band potentially could have a 50-state tax return if you do a 50-state tour. It's quite daunting to think about. Now, sometimes what happens is they might get a 1099. So say they play at a venue here in North Carolina. That venue, if they're a band, has to give them a 1099. So they'll get a 1099 saying, okay, so they know this is North Carolina. Then they'll get a 1099 from their place. But they do or don't, it's their responsibility to report to that state. Some states have reciprocity agreements. What that means is bordering states will not tax you if you live in one state and work in another. DC, if you live in any state and you go to DC and earn income, you don't have to pay any earned income to DC, only the residents. So I wonder who wrote that rule. Yeah, exactly.
Don't get me started there.
Politicians and anything you look into, politicians and attorneys definitely write themselves into these rules.
Oh, yeah. I love how politicians, before they go in, don't want the taxes. And then when they get there, they do want the tax. Oh, gosh, I did it again.
Yeah, look at you. So being aware of that nexus is a big deal. It's also another situation where, say you live in California, and these people that you love, Maury, that you were talking about earlier, that were coming from a high tax state, and they moved to North Carolina in June.
They usually stay here for about a year, then they move to Colorado.
Yeah. Well, then so what happens, that 1 year in 2018, they moved here in June. That 1 year they have 2-state return. They were a resident in California for half a year, and they were a resident in North Carolina for half a year. So it's easy. If in California, you worked at a company, you got a W-2, you pay that tax to California. If you, in North Carolina, you got a W-2, you pay that tax in North Carolina. What's hard is the passive income. What if you have interest? You have a bank account, or you get, dividends. That has to be prorated between the 2 states. One issue I should point out is that, you don't get double taxed on this income. So my point is, if you're that band and you're traveling, you're from, say you're from New Jersey, and you drive to all these different states and have this different state income. The way state taxes work is your state of residency, you have to report all your income to that state. So if they're from New Jersey, all their income gets reported to New Jersey, all of it, even though they earned 90% of it in different states. They report 100% of that income to New Jersey. And then they got to report a non-resident state tax return for each different state, and just put that amount that they earned in those states to those states. And if they pay those outside states any tax, you get a credit in your residency state for that tax paid. So and it's usually the lesser of your state tax or the out-of-state tax. So you end up paying basically the higher tax rate of the either the state of residency or the out-of-state tax. But you get a credit, so you don't, in essence, get double taxed on that income. But if your state of residency is huge, so that's why it might matter if you're somebody that has a lot of passive income. Say you have a lot of dividends, capital gains, maybe even rental income. Rental income's a different. I retract that. That's different. But it's passive, like it's not earned. That's why you get a lot of these people moving to Florida, because Florida doesn't have an income tax. Or they establish residency in Florida and they live there for 6 months and 1 day. If you do that, you're considered a resident, and then they live in their vacation houses wherever they want for the rest of the year.
Well, it's funny you bring that up, because I've met several people in the last few years who are this whole RV community. So what they're doing is either moving to Florida or Nevada. Apparently those are the 2 best states to do this. So they go there, buy a little mobile lot.
Yeah.
Or an RV. Apparently you can lease or something like that, and then you establish residency. Then they take their RV and they go all over the country, and they only have to do a touchback every 6 months or something like that. Do you understand? Yeah.
Well, I mean, what they're doing obviously is establishing residency in a state that doesn't have income tax. And then if they have, there's a pickle there, because say they're a blogging business, right? And they just blog
traveling RV
bloggers, and they blog out of the back of their RV. Technically, they're kind of having Nexus in these these 50 different states they're traveling, but they are so transient with it, and it's so hard to trace that they're just establishing their residency in Florida, and they're not paying any income taxes to any state.
So let me ask you another question. Totally changing the subject here, but you're talking about internet sales. Let's say we become world famous with our podcast.
Are we not already?
I don't think it's quite happened yet. I think we're approaching that point. But let's say we get world famous and we start to monetize our podcast. And hint, we would take sponsorships or advertising.
The 3 people listening might not want to pay for that more.
Anyway, so let's say we start monetizing our podcast, and you and I start raking in the money every month. Where does that fall in this whole set of taxes? The internet sales tax, and where do we pay that?
Well, sales tax is only on products. We're not delivering a product.
Podcasts aren't products?
No.
So when let's say we monetize and we start taking advertising.
Well, we pay North Carolina, but there's no sales tax on a service. We're not selling widgets.
So we need to really ramp this thing up.
And move to Florida or Tennessee. Tennessee's closer.
Okay, I could do that.
But I mean, I've got a client that,
Does that same thing apply to YouTube stars? Instagram people that are getting paid to be an influencer.
You got to keep in mind
Instagram?
that the basic premise is where you're at, where you have your Nexus, is where you're paying taxes. So if they're sitting their seat in North Carolina, but people happen to see it throughout the United States, that doesn't matter. They're in North Carolina doing that service.
But let's say I'm a travel Instagrammer and I get paid to travel to all these different places and do my promoted Instagram posts.
If somebody from Virginia paid you to do an appearance, you're earning that income in Virginia.
Oh, okay.
So that's Nexus in Virginia.
Okay.
So, but if they just pay you to like log in online and do a FaceTime with them, your butt's still in North Carolina, so you don't pay Virginia anything.
Well, there's paid fashion Instagram influencers, and they go around and they actually go to those places. There's travel ones as well, and they go to those places, take the photos, do the posts. Hey, we're here in fabulous, beautiful.
Yeah, and if they got paid, $5,000 to do that, then they owe that state $5,000, tax on $5,000. But if they stay in their state and they just they call in, then you're not earning. You're still in your state earning that money. So, like podcast.
Just a question, because this is actually, I think we're in the midst of this change. Where there's more and more type of things that are happening online, other than just product sales.
But did you have a question?
No, I'm just saying that's why I was asking these things.
Yeah. I mean, it is. But you got to keep in mind, sales tax, every state's different, but for the most part, a product's changing hands. So, I mean, if you're a YouTube star, you're not giving them a product. You're giving, they're watching a show. If you're a podcast star, they're listening to your show. We're earning this money in North Carolina, and we pay income taxes on this money. There's no sales tax. If we were to turn around and start selling Bamit T-shirts, then if anybody bought our Bamit T-shirt, we would have to charge them sales tax for that.
Mm-hmm. So if we got invited to travel to like New York or California and do a live podcast from there and get paid $10,000, we would pay a portion of the tax to that state?
Yes, we would have to file an out-of-state tax return and pay income tax to New York for our unbearably low fee of $10,000.
Well, I'm just saying there are podcasters that have become very popular, and they are now going around doing tours.
Yeah, well, it's just like a traveling artist or a traveling band. If you have Nexus and remember, physical presence. If you're physically present earning money, you owe them tax, assuming that's a taxable income state. Another thing to talk about is rental properties. Say you're like, hey, I got this great rental property in South Carolina I'm going to get, and you rent it out. Well, you have a South Carolina tax return now for that rental income.
Here's an off-ball question. I'm just throwing stuff at you because I like to see how you respond to unexpected questions. So let's say my cat is really popular, because you see this a lot on online, on YouTube, and especially Instagram now, or Snapchat, whatever. So my cat Fluffy is really popular, and Fluffy has his or her own page. And Fluffy, because, Fluffy has more than 200,000 Instagram followers, is making money. So, do I have to pay that?
Yes.
Because I own Fluffy?
Correct.
Fluffy's not its own entity?
No.
But yet Fluffy can receive benefits. So, Karl Lagerfeld died, and he's leaving a portion of his estate apparently to his cat.
Yeah.
Where does the cat have to pay?
The estate has to pay on that. No, that's... Some of it, frankly, I'm ignorant to, because that is a little... I've never had the situation where I've had to represent a cat before. But
did you imagine somebody walks in and said, I've got my
this cat made $1 million last year. I would just say, okay, what's its social? And what's its date of birth? No, I mean, it has to fall somewhere. It's just, if that's the case, then everybody's pets would make all their money, right? They would. I mean, so my point is, if you
Well, I found that interesting because
it's not a secret loophole. I promise you.
Well, it is an interesting issue though, because it does matter when, let's
it's
say,
an
the owner of
interesting-
the cat dies. Who receives the benefit of the income coming to that animal?
Well, that animal is not really getting anything. It's probably going to the estate, and then the estate has to kind of figure out what they're going to do with it, because it's an animal. That it may be like a provision. Hey, make sure this animal is taken care of and fed or whatever, and the estate, the fiduciary of that state will do that. But it's more a social issue, and I'm not an attorney, but it's not a legal and tax issue. Legally and tax, it's not like the IRS is like, oh, darn, they got us. He gave it to the cat. We can't, there's nothing we can do about that, you know?
Well, that was more than $1 million. I mean, that's a huge estate.
I know. And the estate will have to burden that.
I hope I come back as a celebrity
and
cat.
I'm sure that was more, like I said, a social issue. There's probably a next of kin on there that's like,
okay, I just like throwing out these oddball questions.
yeah, I mean, I will plead ignorance on some of the nuances, but I'm pretty sure it's not a loophole leaving things or having an animal earn income, even though the animal may be the centerpiece, like your Fluffy you're referencing. You know, if that's the case, then my dog has become quite a good tax accountant and has earned a lot of tax revenue this last year.
Yeah, but your dog doesn't have 200,000 Instagram followers.
How do you know? No, he doesn't. You know. Okay, back to state taxes. So we talked about Nexus as being a big thing. Basically, if you're in a state, you pay that state. If you go to another state and earn money in that state, you pay that state. Passive income, that's non-earned income. You just pay to the state of your residency, which is why it might matter, you know, if you're in a non-tax state or not. You know, if you're somebody that you're retired and all your income's passive at this point, you see a lot of retirees go to Florida. It's not only because of the climate, because all their income you're saving on whatever that state income tax rate is. North Carolina just under 5%. That's material. Certain states is material. I'm trying to see if there's anything else I've left off on states.
I don't see anything from your notes. I think you've covered a whole lot of stuff.
Nexus considerations, out-of-state income. This is the planning. So it's really just to be aware of what your state taxes and what it doesn't. Sales tax is scary for small businesses.
Well, I know I say
and
this.
Confusing.
I know that I may say that taxes are not that interesting, but believe it or not, somebody is probably going to hear this, and it is probably interesting to them.
You think somebody will actually?
I actually do think that you go into so much detail about stuff. It's actually very helpful versus all this cursory stuff that we read online.
Well, I get this question a lot. I get a lot of clients coming to me and saying, "Oh, I moved here from out of state, and it's just typically my taxes aren't that confusing." But now, since I moved from another state, it's going to be a little bit more confusing. Can you help us out this year? And it comes up a lot, state taxes, and that's why I was like, it'd be kind of cool to talk about like what.
Well, that's probably very relevant here because now like 80% of the people moving here are from out of state.
Yeah, and there's a lot, and so you get 2 state tax returns, and we also have a lot of people that live here as a hub. Travel around and earn money doing something, bands or something.
Well, my sister moved out of the country for several years, and when she came back, she didn't realize that even though she was living out of the country for 30 years, she still had to file taxes, and so there was a lot of catch up to do when she came back.
Yeah, foreign taxes are very similar to state taxes. If you're an American resident, you're an American a citizen, you're an American citizen no matter what. So you owe tax to American citizen, just as if you're North Carolina
Even if you did
resident.
not live here for 30 years and
Correct.
You did nothing here, you still have to file a return.
You still have to file a return to the United States. However, if you live in another country and earn money in another country, you get you get a foreign income exclusion. And it's up to, give or take, a little over $100,000 a year of foreign income exclusion. That if you live in another country for, over a year, then you can exclude that. You also, if you earn money in another country and you don't meet that exclusion, you get credits for foreign taxes paid. So kind of like, it's very similar to the way state taxes work. If you live in one state, pay tax to another state, you get a credit for that state. In America, if you go and work in another country and you pay tax to that country, you get a foreign income tax credit for that. I'm hoping I would love to, this summer do an episode with my brother, who is a partner with a big firm, and he's working in London, and he's headed the international tax desk in London, and we can delve really deep into what international taxes are like and what it means.
But go back to a question I want you to really be clear about, which is you are over 18 and you do not work or live in this country, but you are a citizen of this country, and you live out of the country for several years, you still have to file a return no matter what.
Assuming you have something to report, yes.
But I mean, what if you had nothing to report? You didn't live here,
Yeah,
nor
well,
did
if
you
you-
work here. So
Yeah,
why
but
did
I mean,
she
if
have
you,
to go back and file all these tax
well,
returns?
did she have money? Did she earn money? How did she live?
She was married. She didn't have to.
Who is she married to?
Not a citizen of the U.S.
Okay. Well, I mean,
I'm
you
not
don't
going to
have
get
to
into
file.
her private financial
No, I
matters.
know.
I'm just saying that.
I'm just
let's
saying
say
that you.
the scenario is, let's say she didn't work at all, didn't need to, or maybe she was just traveling and whatnot. So, what would she have to file?
Well, in that case, if she doesn't make any money, there's nothing to file. You don't have to file an income tax return if you don't make money.
But if she got a job in that other country, she'd have to report that in this country.
If she had reportable
if it was
income,
over 100,000, but if it was under
No.
100,000,
you have to report it if it's 15,000, but you might not have to pay any taxes.
okay,
It doesn't mean you don't have to report it.
gotcha.
If you have $10,000 in a foreign bank, we're getting into foreign stuff now. If you have $10,000 in a foreign bank account, you have to send that in and report. You don't have to pay tax on it, but you have to tell the government that you have $10,000 in a foreign bank account or more. There's all types of nuances and stuff when it comes to foreign, and even I've done a good number of foreign residents that move, move here from Germany, go to school, work for a few years, and then move back. I've done some of those. Those have their own implications, and even some countries have treaties that they don't have to pay any income tax in this or any social security tax or something. Social security tax, generally, they don't have to pay foreign residents. No. But even my point I'm getting at is sometimes a country will have a specific treaty exempting them from having to report anything. And it can be really confusing. And even though it's a student that worked here and made $20,000 a year, it can be a really confusing tax return.
Well, here's something you see in our state a lot, and I guess in other places. Flea markets, and then people who sell stuff on the side of the road. You see, roasted peanuts or honey or whatever they're selling on the side of the road. Are they having to report that?
Yeah, well, yes.
They should, right?
Yeah, I mean, if you sell a commodity or you receive money for a service, that's a taxable event. So you might give them $5 cash, and they don't charge you sales tax. They have to pay that sales tax themselves if they didn't collect it.
Okay, so I think I've asked you enough difficult questions to throw you off. You did a very good job. Thank you, John Michael, believe it or not, of providing a lot of
Believe it or not.
information in this episode on state and local taxes. So we want to thank you for joining us on this episode. Next up, we've got an interesting topic. See, I'm saying it's interesting. I say all of our topics are interesting, John Michael.
Yeah, but not so sarcastically.
Well, I mean, okay. Granted, maybe I'll level off a little bit. So we're going to talk about a boring subject called fishing. And what does fishing have to do with marketing? And that's my off-topic discussion that we'll be diving into next. So other than that, I'd like to say thank you for joining us. This podcast, BAMIT, is brought to you by Peridot Consulting and Marketing Outpost. Please be sure to review this episode, and for more information on who we are or this podcast, please visit www.bamit.com. That's BAMM-IT.com.
All right. Thank you, guys.
The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice and is for entertainment purposes only. The hosts and guests of this podcast may make terrible attempts at being funny, and this podcast does not defend the merits of this humor, nor does it guarantee that the humor will be successful. It is not guaranteed that you will find this as entertaining as the hosts find themselves.